Hey, what's up, all of you beautiful subscribers? Welcome back to the Chapple Show. So should you fear the stock market? We're going to be talking about that along with some big news from Google, Tesla, even Barnes & Noble, McDonald's, just a bunch of business news in general today. Obviously, our stock market winners and losers, and a little bit touchy thing on maybe homes and millennials. We'll see if I can get to that in a second. But anyways, we want to talk about should you fear the stock market here. So there was a bunch of articles that came out like this that pretty much said, Wall Street's fear gauge poised for a new record low, and so what should you guys take from this? What the hell does all of this mean to you guys? So what the VIX is, if you don't know what the VIX is, it measures the volatility. You're allowed to bet on this. You're allowed to invest in this. So you are allowed to invest in the predicted volatility of the stock market. I know it's a little bit complex. I'm going to try and break it down as simple as possible. So what the VIX does is the VIX prices rise when there's lots of volatility. Lots of volatility usually happens when there's some sort of crash or economic downturn. So, meaning that the lower the VIX is, then that means that the less money is going into a predicted crash. That's what all this means here, is that investors are not expecting a stock market crash in the next 30 days. That's all this means. And yet there's a bunch of, big news articles here talking about this, how, you shouldn't fear the stock market whatsoever. But here's the deal, is that what we do know is that valuations of lots of companies, mainly tech companies, are at not an all-time high, because in 99, 2000, 2001, the tech bubble, they were higher back then. But the stock market as a whole in the United States is overvalued more now than it pretty much has ever been. And so that's usually a sign of bad things, meaning that there's lots of investors are pumping money into the stock market wanting to have good returns, but there's not a lot of companies to put them into right now. And so that's usually a bad thing when prices get very inflated. It's usually a bad sign here. Do I think that we're in a bubble? No. Do I think one's forming? Maybe. So my opinion to you guys is like this. I think I made a video about this about a few weeks ago, talking about how to invest in the stock market for beginners, July 2017. And so my advice to you guys is this. Should you fear the stock market at this current second? No. Should you be a little bit more responsible now than you should have been in 2012, 13, 14, when everything was going really great? Yeah. And so my recommendation is whatever number you want to invest in the stock market. So if you want to invest $10,000 in the stock market, don't invest that whole $10,000. Maybe invest $8,000 and put $2,000 in some sort of a savings account just in case something were to happen in the next few years. That's my recommendation to you guys, especially if you're just starting out. However, if you know how to invest in the stock market properly and you're hedging your bets, then you can invest all of it. But most of you, I know, that subscribe to me are beginners to intermediates. And so that is why I recommend don't invest everything you got into the stock market. This is not the time to go all in, because we're at the end of this economic growth cycle. We're in year number 9 of a 10-year growth cycle. There's never been a time in the economy where we've gone 10 straight years of growth without a recession happening right after that. 10 years is the limit. So by the latest, the end of 2017, theoretically, that should be the latest time that we should have some sort of recession or correction in the stock market or the economy. So that's my opinion. Should you fear the stock market? No. Do I think that you're going to get a lot of value out of stocks right now? No. No, not right now. So that's my overall opinion. What do you guys think? Do you guys fear the stock market? What's your opinion on that? Are you investing right now? Are you just jumping in right now? Are you buying stuff right now? I'm still investing, but again, I'm allowed to do that because most of you watching this, you have one job, you have one main job, and then you invest in the stock market. For me, I got more businesses. I guess I'm starting my 4th major business right now. I have about 7 sources of income, 6 to 7. And I'm not that, if the stock market were to collapse and all my assets were to go to zero in the stock market, I'd be completely fine. And so I always recommend to you guys, just try and hedge your bets. Don't go all into the stock market. Spread out your investments. Put some in the stock market. Start a business. Put some in real estate if you can. Just try and spread it out so that if the stock market crashes, or if the real estate market crashes, or if your business goes to crap, that you are able to survive and all of your portfolio won't go to zero. That's my recommendation for you guys. So anyways, we're going to move on to the next topic here. So we talked about the VIX. We talked about the fear gauge. We're going to move on to the big news I wanted to update you guys on, which is actually a lot of CNBC articles today. So Alphabet. Alphabet is Google. That's what that means. So anywhere time you see Alphabet Inc., that is Google. And so this is ridiculous. So Google's stock dropped, even though they beat expectations across the board pretty much, apart from the fact that the cost per click went down 23% from last year. That's the one negative they had, and the stock has dropped. They're a stock market loser today. They've gone down 3% today, which is almost $30 a share today. So again, this is something you can just see it here. Their earnings per share $5.01 for compared to $4.49 expected. Revenue was $26 billion, up from $21.5 billion last year at this time. So this is just their quarter two revenue. So they're going to hit $100 billion this year in revenue. Great for Google. Paid clicks were up 52%, meaning that more people are buying Google AdWords, which is bad for people like me trying to start businesses online. But overall, Google had really good numbers. Google, I mean, if they didn't have the European Union fine and they didn't have the YouTube ad boycott, they would have gone up 3% today. I think that it was estimated that they would have had an increase in net profits by over 28% if they didn't get that fine from the European Union. So take whatever you want from that. I mean, Google is... They're still one of the crazy for such a giant market cap company. They're still growing really, really fast. I mean, this is a 20% growth right here from 26 billion quarter two 2017 from 21.5 billion quarter two 2016. I mean, that's a 20% increase, guys. And this is a company that's valued at $600 and something billion right now and has revenues of going to be over 100 billion this year. This is still a high growth company. This is something like Amazon right now. This is crazy. And I mean, I don't know why the stock went down. Maybe I should buy it right now. Buy it at a discount of 3% today. I might do that. We'll see what happens. So we're going to move on. What do you guys think of Google? Do you think that the stock should have gone down? Do you think that you believe in them to hit the future? Let me know in the comments below. So we're going to move on to the next topic here. The next topic I want to talk about is just something that I actually I've heard of both of these companies before. Actually, I've known Michael Kors, but I didn't really know what they were. I guess I assumed that they were a clothing brand, but I guess I didn't know what they were because they're a luxury clothing brand, I guess, and I don't really buy luxury clothes, as you can tell from my school sweater that I'm wearing with this in the office right now. So Michael Kors bought Jimmy Choo. It's funny that they named both of their brands after themselves, which is really, but that's what you're supposed to do in the clothing industry, right? Like you got Calvin Klein, you got freaking, I guess, Michael Kors and Jimmy Choo. I don't really know too many of the high-end names here. But Michael Kors, I believe, bought them for $1.2 billion. Jimmy Choo, yep, $1.2 billion right there. And so what do I think of this? I just think that you got to go to e-commerce, which is what I guess that they're doing here. Oh, they mentioned it right here in this article. And I guess the luxury brand, I don't really know too much about this. This is one of those very, very few things which I don't really have much of an opinion on. Because I honestly, I mean, I'm not afraid to admit this. I don't know anything. I don't know anything about luxury clothing brands. Okay, I know some about retail brands, like classic retail brands that I talked about, like American Apparel and all those True Religions, all those ones that go bankrupt and stuff. But when it comes to this high-end luxury, that's a whole different ball game. You're talking about super, super wealthy people that are buying the clothing simply because of the name and that they can tell people it's expensive. And that it maybe is a little bit higher quality and looks a little bit better, right? So I don't really know too much about this. But what they said here was that Michael Kors is going to be buying some more luxury brands here. So I'm guessing that they're doing well. Maybe we should check up here on the we should check up on Michael Kors stock. That'd be a good idea. Michael Kors stock. I probably typed that in really wrong. Michael Kors stock. Okay. So let's see how they've done. So they've been going downhill since 2014. I'm guessing revenue was a lot higher. 2014, you see a lot of big retailers and clothing brands start going downhill, largely because of e-commerce, Amazon, the Amazon effect. And so here's what I don't like. Since essentially a few months after their IPO in 2012, if you were to invest in them in 2012, you would have had a loss of 27%. And so the revenue is $4.71 billion. So they're still, I'm assuming that they're a healthy company. I'm guessing they have high margins too because they're a luxury brand. I just don't really know. I'm not a luxury brand person. I can't really give you guys much advice of whether to invest in them, what to think of them, what they're like as a company, because I mean, luxury people, they still like to go to the store and buy stuff. They don't necessarily like to buy Michael Kors online all the time. So I don't really know what to think about that. What do you guys think of that? What do you guys think of Jimmy Choo? Apparently Jimmy Choo is a shoemaker or luxury shoemaker brand or something like that. So anyways, we're going to move on here. Next topic. We're going to move on to, so Tesla, this is just an update story. So Tesla's Model 7, Model S, as you guys know, the stock went down because the safety features for the Model S were rated acceptable and not like world class by Consumer Reports. This was about a month ago, and the stock dropped off a cliff. And today, apparently, they fixed the Model S, and it's back to the top-rated safety sedan by Consumer Reports. And that's just a story that I promised to update you guys on when stuff gets updated. So, not a big story here, but, Tesla Model S, super safe. I'm probably going to buy one in the next 10 years. So we're going to move on to, one thing I want to talk about was, so the S&P, I guess, closed at a record high, but I don't know if I should touch on that. I don't want to make this video too long here. So this is just a funny topic I want to talk about was that, Lyft on their app, the riding delivery app, or the ride as you go, whatever, the little cousin to Uber. So what they're doing is they're gonna incorporate a Taco Bell button, meaning that you can literally get driven to Taco Bell through the drive-thru and then dropped off back at your house or wherever you want to go. And that's a key feature that's going to be incorporated into Lyft. And I just seriously think, what do you guys think about this? I think it's a funny idea, but it might work. Especially if they get more companies that don't do delivery, if they do a McDonald's, if they do a Burger King, if they can get those brands to sign on, the ones that don't do delivery, because I thought Taco Bell delivered, but I guess not. This could be a big feature. This could be one of those separation features between Uber and Lyft. And I know it seems like a stupid, funny idea, and it kind of is, but it could be good. It could be really good if they can get some of the bigger brands in there. Because think about this. All those 16, 17, 18-year-old people, they don't have cars. They don't want to pay an extra $10 to get their food delivered. They can't get the McDonald's that they want. So what? They can go get a ride for a few bucks, for a Lyft or Uber ride, which is, at 1 a.m. or 2 a.m., they can get a ride, go ride down a couple kilometers, go get the McDonald's and come back. Or go get the Taco Bell and come back. I mean, I seriously could see people using that feature. I wouldn't, but I could see people using it. So what do you guys think of that feature? Would you guys use it? Let me know in the comments below. So one thing I wanted to talk about before moving on to stock market winners and losers was just this infographic came up here from Bankrate. And so it pretty much says how much millennials spend compared to other age groups. And keep in mind that all studies like this, they're only come from one source. They're not, great studies. They don't have a large sample size usually. But so what this says here was that millennials spend more on groceries. It's kind of, here's my opinion. They spend more on groceries compared to other age groups, gas, restaurants, cell phones. And so I didn't really expect that. And they use less on television and travel. This is what's really, really surprising to me, is that I thought millennials traveled more than people, I don't know, in their 30s and 40s and 50s. I seriously thought that. I didn't know what else to expect. But apparently millennials travel a lot less because, I see all my friends, they're 21, 22, 23, 24 years old. Right after they graduate, what do? They go on a trip. Oh, I'm going to take 6 months off and then I'm going to go work at a job making $50,000 a year for the rest of my life. And that's seriously, I'm not trying to make fun of them, but that's usually what happens to a lot of millennials. You go on a trip for 6 months right after university or college because you celebrate, and sometimes you take out a loan, sometimes you use your parents' money, sometimes you saved up $3,000, your last $3,000, and you go on a trip. And that'll be fun. Sure, that'll be fun. You don't have responsibility, but I'm of the opinion that you should be using that time instead of going on that trip. You should be using that time to build a life where so that you can go on a trip whenever you want in the future. That's my personal opinion on that. Right now, seriously, if I wanted to, I could pay for myself and all of my close friends and we could go on a trip somewhere. I have enough money to go and do a luxury trip to, not just a normal freaking road trip to Florida or something. So that's just my personal opinion. What do you guys think of that? Television, obviously, millennials spend less because spend more on internet. Internet's more important. Spend more on cell phones. That's okay. But restaurants, like, this is just something that's, you shouldn't be spending as much as you think you need, I guess. Usually millennials are a little bit more entitled, think that they need more than they actually do. And sometimes it's the opposite. I mean, sometimes, millennials have to go eat at McDonald's every day because they don't make enough money. And I see both sides to the argument here. Advice to everyone out there is just, spend your money wisely. Realize that you don't need that $6 lunch every day and that $5 Starbucks coffee. Put that towards your rent and you'll be a lot happier with your life. You can trust me on that one. So we're going to move on to the stock market winners and losers here. Barnes & Noble. So they're up 16% today. Oh, it should have closed. This should update right now. So they're up 16.55% today simply because one investor of the company came out and said, we need to make this a private company because we need to sell this to an e-commerce company because we're going bankrupt. And we can take a look at the stock here. So they pay a 7% dividend. Again, this is one of those companies, high dividend. They probably haven't changed it over the past few years. They want to attract investors and make sure that you have confidence in the company. But this is the Amazon effect here. They've been public since 1993, Barnes & Noble. If you invested them in 1993 during their IPO, you would have lost 41% on your money. However, they pay a dividend, so you probably would have ended up making some, but 7% per year, you would have made some money. But still, what do you guys think of Barnes & Noble? I think it'd be a good idea for them to sell to an e-commerce company, but who's going to buy them? Amazon's not going to buy them. Maybe I could buy them in the future. Wouldn't that be funny? What if my e-commerce marketplace were to take off and then I could buy them? They're only $595 million, but why would I need to buy them though? I guess a stockpile of books? I don't know. We'll see. I wouldn't need all their employees. I think I could just buy a bunch of books on my own. But so Barnes & Noble, McDonald's released their earnings and they killed everything. So they're up 5%. This is massive news. So McDonald's is a big company, obviously, and they're up 5% in one day. You don't see that from a lot of big companies these days. So they're up, or I guess 4.71% they closed at. So their earnings were great. They killed everything. Their $1 drinks absolutely did very well, as they do every year. $1 drinks are one of the things that McDonald's makes a lot of money on. Because honestly, teenagers will walk in 14, 15, 16, 17 years old. I did this. Walk into McDonald's and just get a $1 drink. And then that's it. And then walk out. Get the drink and walk out. And so what that's a 70-cent profit. I know it's not much, but when you get, millions of teenagers using this, tens of millions of teenagers all across the world, not just teenagers, just people that, need a cheap drink or a cheap source of sugar, calories or something. It's a good marketing ploy. It worked on me when I was a kid, when I was a teenager. I would buy those $1 drinks. So that was a surprise today. They're up 4.75%. I think that should have closed by now, though. So I don't know why this is still going here. I guess it's after hours. So we're going to move on to stock market losers, which is Domino's. Domino's down 10% today. And I think that this was a weird one. I was looking at the stories here, but I believe that I looked into some of these here. I didn't get exact numbers, but their earnings and their revenue beat the expected amounts per share. However, their international sales were not as good, which dropped the stock 10% for some reason. And so my opinion on this is just, this is one of those Wall Street overreactions, which I talk about almost every episode now. And this is one of those. So Domino's Pizza, again, it's kind of funny because we talk about bricks and mortar going the way of the dinosaur. Pizza places are not going the way of the dinosaur yet. Maybe a little bit of the bricks and mortar operations. I mean, there's not as many people sitting down in restaurants to go get a slice or go to eat a pizza in the place like there used to be. But I don't know. I think that they're not going anywhere for now, these kinds of restaurants and pizza places like Pizza Hut and all those places. But I think that it's really strange because I was watching Shark Tank recently, and there was an episode a couple of years ago about how someone was flash freezing pizza freshly cooked from the oven, flash freezing it and selling it through retail and online, which was really, really fascinating. And I think that could be the next evolution of pizza. You're kind of like getting a fresh pizza either delivered to you through online or bought at a retail store for like $5 to $10. And I think that could be the next evolution of these kinds of pizza companies here, but we'll see what happens. Next, the last stock market loser is Google because, well, we talked about them already. They had really good revenue and good earnings. It's just, their fines hit them, and people didn't like that cost per click was down. So, revenue or earnings per click or whatever the hell metric they used. And so, again, I might be buying them at a discount. We'll see what happens over the next couple days. But anyways, I think that's going to wrap this video up. So what do you guys think about everything? Leave a comment down below. Make sure to check out my stock market program if you want to learn how to invest and you want to see my portfolio. Check that out. Links in the description. Plus, you get the Wealth Accelerator too, so you can get that. And yeah, just thank you very much for watching. You're all very beautiful people, and I'll see you guys in the next video.